So who was next? I believe I said Ravi was next, okay? And Ravi's needs a stock repair idea. All right, so he says, Mike, can you throw some ideas to fix the long stock XPEV bought at 24? Okay, well, my first step is always going to be just to go to the stock repair tool first, Ravi. That's what I'm always going to do because it's simple. And again, I'm going to let the computer work for me and do these equations. And if I don't like the stock repair, well, I've got some other ideas, don't I? But let's go to the stock repair first. I'll put the symbol in up at the top here. We're going to click on stock repair. Sorry, folks. You can tell it's Friday at 5:34 p.m. because I'm typing in Ravi's name rather than the actual stock Ravi needed to fix. My apologies. And we're just going to assume 100 shares just to keep it simple, ladies and gentlemen. Let's submit it. As we saw a little bit earlier, very briefly at the beginning of the presentation, when I was talking about my UVXY position, when I bought it around 21 and it dropped to 16, 17-ish, and I had mentioned I had done the stock repair. Well, this is the same thing we're looking at for Ravi right now. I've got nothing in November, nothing in December. The stock's down to 1938, down about 5 points on a $24 purchase. Okay, so about 20% down. Now, I see repairs out to January of 2021. Now, the power of the stock repair tool, again, as we saw, is we're going to buy one strike and sell two. We're probably going to be able to generate a net credit, and what that's going to do, in addition to the benefit of the bull call debit spread, is get us to a break even that is much lower. Now, before we jump into that, when you plug in your numbers into the stock repair and you see this first one for November, and it gives you all the numbers, it says, okay, well, it's currently at 1938. The stock's at 23. It might look pretty good. You're going to buy a 17.5. We're looking to sell 220s, ratio call spread, but it's covered because you own 100 shares of stock. You do get a net credit, but then the break even is NA. What does that mean? It means this November repair and this December repair, although a net credit could be generated and a ratio spread could be calculated that gives you a credit, it doesn't get you back to break even. You'd be locked into a loss. Okay, it would be below your cost basis still, but it could build a ratio spread. It just doesn't get you to break even. So we'd be looking at January. And the first one that comes up, I kind of like the 17.5 to the 20, a net credit of 240. So right away, that's going to drop your cost basis down to 2160, right? You have a cost basis of 24, Ravi. We're going to collect 240 in for this ratio spread. So we're going to drop our cost basis down to 2160. How is my break even at 1955? It's because of the structure, right? I'm buying one call and selling two, which effectively is creating a covered call and a bull call debit spread at 17.5 to 20, which means if the stock is up near 1955, the 20 calls would still expire, but your long call that you essentially received at a credit would be worth $255. That's $4.95 back to the $24 range, the stock at 1955. Let's take a look at the profit and loss chart. I've got XPEV at 24. I could buy one January 17.5 call at 460. Sell two January 15-20 calls for $350. So I'm going to get $7 in and pay $460. That's the $2.40 net credit, which takes your total cost in the stock down to $21.60. Again, how do I get back to break even at 1955? See this accelerated move here? That's because as the stock's moving up, you're gaining on your 17.5 long call and gaining one delta on your stock. Yes, you have a capped upside here above 20 strikes, above the 20 strike call, excuse me. But now you only need the stock to get back to 1955. It's currently trading at 1938. A simple repair. Concern with the repair is always what's an issue. Well, number one, we're going to have, as we mentioned, many of us are expecting up and down markets between now and January, between now and the election, even 2 days away, between now and December. Stock repair doesn't address the downside. If the stock continues to fall, yes, you lowered your cost basis down to 2160, but there's no hedge here. You say, oh, well, can I buy a cheap put? You could, but then that's going to add back to the cost basis. And this repair, if that put is cost more than 90 cents, you're not going to have a profit to the upside with this repair. Okay, so that's the trade-off there by buying a put if you're still worried about the downside. The common answer, of course, is if you're still worried about the downside too much, you're worried about more risk, you might just want to close the position and get out. But this, to me, is a very reasonable stock repair for this position. If you think the stock's going to stabilize or move back up, yes, you have to wait till January to get the full profit. Okay, this full profit is realized in January. You can see that here. The curved red line is showing you the halfway point, because if the stock moves up, yes, your long is gaining, but your two shorts are also gaining in value, which is a negative to you. So you don't have that positive delta. At expiration, when all time value is gone in January, some 75, 78 days away, that's when you'd see the max profit if the stock was above 1950. I'm sorry, above 20, it'd be a break even at the stock at 1955. If you don't like this repair, if you say, well, I would rather do a November repair or December repair, I understand, and naturally wouldn't we all? Why do I want to go out to January if I can try to find a repair here? There are debit repairs that you can do. The risk with that is it's still building you a ratio spread, but it's done at a debit, which increases the cost basis, which means if the stock falls, you're taking on a higher risk as well. You're losing the debit that you paid in to get to the repair, and you're losing more on the stock position at the same time. Okay? So an alternative here is that if you don't like that, excuse me one moment, let's see what we've got here, shall we? Okay, so if it's never a great idea to put in more good money after bad, of course, but if you had the funds and you had a small amount of shares, you could also try to average down right now. So if I only had 100 shares of this stock at 24, and I buy another 100 shares at 1938, my average cost per share for the 200 shares now is, sorry, I did that wrong. I'm over here on the calculator. I think I divided by 200 instead of by 2. So I think I was right with my cost, 2169, yeah. Okay, so if I average down right now, I'd have 200 shares of 2169. Now I can see a November repair where I only need the stock to be at 1935, a December repair where I only need the stock to be at 1890. Now, I'm not saying it's a good idea to throw good money after bad and average down, but the reason why you would use a repair in the first place is because you think the stock is done falling and it's going to move back up. Any type of repair of this scenario that you do, Ravi, whether it's a stock repair or whether you're expecting to try it with a stock at 1938, you're planning to just sell November 20 calls to start lowering your cost basis and hope it expires, then sell maybe December 21 strike call or a 22 strike call or 22 and a half strike call. You're planning to sell out of the money. That repair of just selling calls so you don't get assigned at a loss, of course, it doesn't ramp up and get you assigned at a loss. But that type of repair of just selling out of the money calls to lower the cost basis to get back to break even and hope it doesn't break through it, or this stock repair is based on expecting the stock to move back up. If your now sentiment has changed, excuse me, if you have a bearish sentiment on this position, yeah, you could buy two puts to sort of take advantage to the downside, but why do that? Get out of the position. No one wants to take the loss, but it's better than taking a larger loss if you're not sure of this particular stock, what direction it's going or what direction the market's going. Had this conversation today with a gentleman, very similar discussion. It was based on a covered call, of course, that had moved down against him. And he said, well, gentleman has been very successful since being with Power Options a few months ago and following different ideas that I believe Ernie talked about during coaching sessions and some other screens that he's developed himself. I think he said only 3 of his 30 covered calls that he's been doing since August or September have gone negative. Of course, 2 of them are this week, and that's the frustrating part. And the one he's really frustrated with is not doing what he wants. But when you get down to it, just a stock that's dropped, there are repair ideas you can use. You could just sell out of the money calls, and it might take you, 6 to 8 months to get back to break even. Let's just take a look. If I just sold the out of the money 20 strike call here, it's better than I thought. Premium of around $2 with a lot going on this, the volatility in the market. But selling the out of the money 22 and a half, let's say, for better range of not being assigned, Ravi, my apologies, you're getting about $1.25. Okay, well, you're down 5 points. So that would be what? 4 right cycles. So that would take you out 4 months or 120 days till we'd roughly be at March expiration. Okay, so if the stock stayed the same or just stayed below 22.50, and you're able to get $1.25 for this out of the money call without it blowing above it and you having to pay more money to roll the call or getting assigned at a loss, of course, it would take you about 4 or 5 right cycles to get back to break even, right? Because you're down 5 points roughly. You get $1.25 each 20 to 30 days. With that further out of the money strike, so you don't risk getting assigned at too big of a loss if it suddenly gaps up. You don't have to pay too much money to buy it back. It would take you about 4 cycles, about 120 days going out to March. The repairs got you set up for January, shorter term, or if you average down into November, with needing a break even only at 1935, which you're effectively at right now. But of course, you got to wait for the time value to decay out. That's what I have right now with one of my stock on semiconductors. I've got a November spread. As long as it stays above 22, I'll get out with a profit. I bought this stock originally at 23 as a married put with a 25, rolled the put up to 28 as the stock moved. Then the stock collapsed and it went down as low as 16. So I rolled the put down, tried to control it, and then it gapped up again suddenly and then fell again. So I was done with it at that point, but I was greedy. I don't want to say greedy, might be smart, but should have gotten out of it a long while ago. But I did a repair on it. My initial repair didn't work. The stock ended up between the strike prices, which did what? It gave me a net credit, and I was still able to close the long call for an extra 30 or 40 cents. So then I did the November repair. The stock's now at 24-ish, 25-ish, I believe. As long as it stays above 22, I'll be back to break even on this position, where I would have had an 11% loss in August had I just closed it. Not the best of trades, but I'm not taking a loss. I think my max profit's like less than this. I think it's 3.8% instead of 6.2. Ravi, those are the ideas. I know it's a little bit complex. Let's take a look, breakdown as I normally do for this, and then we got to move on to Wes and Daryl again. But this is a ratio spread, okay? And this is with the averaging down, Ravi, of course, too, as well. Let's take the stock out. And this is never a position I recommend on its own. Why? I'm selling twice as many calls as I'm buying, so you get this infinite upside profit, infinite upside loss. Fantastic. And here's this ramp. What is this? This is that bull call debit spread aspect. The 17.5 long, the 20 short. So if the stock's above 20, what does that mean? You get $2, I'm sorry, 17.50. You get $2.50 back. That's this acceleration here. That's the 250 you get back from this ratio spread. Why do I have infinite loss to the upside? Because I sold 4 in this case and bought 2. 2 of these are naked calls. But now that I average down, what do I have? The 200 shares of stock. So effectively, I have a covered call with half of these short calls combined with that bull call debit spread. It'll give me an extra 250. If the stock's above the short, nothing is naked. No margin is required. Everything is covered. You've got a covered call with a bull call debit spread once you have the stock back in. So I would never recommend doing a ratio spread by itself, but in the context of owning the stock, or of course, even owning the stock as a stock repair in a married put position, or what we sometimes refer to as income method number 5, no margin is required. You still have risk to the downside. Don't get me wrong. We haven't hedged that yet. Okay, but there we go as well. All right. So Ravi says, great. Thanks, Mike. You're very welcome.